Good afternoon. Welcome to this Hamptons webinar. I'm Simon Reed. I'm a financial journalist and broadcaster. You may have seen my work in most national newspapers or most TV channels or radio stations. I write a lot about finance, so I've written a lot about property and buy-to-let over the years. Now, what we know about buy-to-let is it can be hugely attractive investment. People say that property, spending money in bricks and mortar is the best investment you can make. You can come up with any figures that back that up. Even today, the latest house price figures from the Nationwide Building Society, they publish monthly figures. They said today that house prices in the last 12 months have climbed 14%. 14%. That's a massive return. And the highest figures for something like 18 years. Now, 14%, that equates on a typical house to around £33,000. That's a bit more than the average salary. So for someone who's on the average salary, who lives in a typical house, they will have made more in the past year from their property than from their job, from their work. That's quite a sobering thought. And it might tempt me to sit back and just see the money rolling in from property. But of course, life is never as simple as that. And buying a buy-to-let property, becoming a landlord, does of course bring its own problems. One of the biggest problems is finding the right location, finding the right tenants. Void periods, when you have no one renting your property, can be awfully expensive and really put a big hit on the returns that you hope to make. And then in recent years, there's been various new red tape, regulatory, new laws, taxation. The government seems to be decided to try and stop people buying buy-to-let, investing, becoming landlords for a variety of reasons. So what we need to think about, and anyone who's thinking about buy-to-let and people who have been landlords for some time, needs to know what's happening now. Now, we obviously can learn from the past, and it's important to know what's happened in recent years to see how we've got to where we are now. But it's also important to look ahead. If you're thinking of investing or investing further in buy-to-let, you want to know, well, what's going to happen? Now, there's no guarantee, of course, that house prices will continue to grow. But we do know that if you buy the right property at the right place with the right tenants, buy-to-let can give you a good yield. And by yield, I mean that's the money you're getting in from your investment property every month, every year. So it's attractive, but it's fraught with danger. So that's why you're here today. You want to find out more. So I won't keep waffling on about the little knowledge I know, because what we have here are a few experts who know an awful lot about buy-to-let and the mortgage market. They're going to give you the benefit of their insights. Before I introduce them, let me say we welcome your questions because we want to hear what you think. We want to be able to share our wisdom. If you do have a question, there's a chat function on let's see, that's the right-hand side of the page, which should be that side, I think. And you click on the chat function, put the question in, and then we'll answer it. We'll answer it later on. First of all, before that, we'll have Q&A with the panel. I'll ask them some of the things that I'm interested about. But before then, we're going to hear about a great new report from Hamptons. So let me first introduce the panel, the experts we've got. Head of the panel is Aneisha Beveridge. She's head of research at Hamptons. She's the one behind the report. She's an economist. She does a lot of housing analysis. What she doesn't know about the buy-to-let market isn't really worth knowing. So in a little while, she's going to take you through the latest report and explain what we know, what we've learned from recent times. Alongside her, we've got Catherine Westerling. She's head of lettings at Hamptons. Now, she's got more than 20, looks much younger than that, but she's got more than 20 years property experience in residential lettings. So, she can answer anything you want to ask about it and give the answer. Alongside her, we've got Ralph Evans. Now, he's from Capital Private Finance. He's financial services director there. This is a big mortgage brokerage, and Ralph has had loads of experience in that market. He's been at Countrywide, Halifax, Lloyds. These are all names you know. So you know that what he's got to tell you is backed up by years of experience and knowledge. So that's the panel. The first person we're going to hear from is Aneisha. As I said, the report is called Building a Buy-to-Let Portfolio. I would recommend you have a look at it because it's actually entertaining as well as really interesting. So I'm going to hand over to Aneisha, who's going to take you through what she found out in this report. Thank you, Aneisha.
Thank you, Simon. Well, I think as you just touched on, actually, the buy to let market has been through a little bit of a rough ride over the last few years. And following on from a report that we produced last year, which looked at whether the sums still stack up for buy to let, we wanted to delve that little bit deeper and actually look at how investors can take things that one step further and sort of grow a portfolio. I guess a bit of backdrop. I think we are currently living in the highest inflationary period for more than 30 years. And it's one of the reasons why buy to let purchases have actually hit the highest levels since 2016. And given that there seems to be a little bit more appetite for buy to let around at the moment, we've tried to sort of draw upon some of the lessons for both new and existing landlords that they can take from experiences in the past. And that's what I wanted to present to you all today. So, to kick off and to hopefully get the most boring bit out of the way, I just wanted to quickly run through and give you an overview of the methodology from the report. The big question we've asked ourselves is if we had £50,000 in today's money, which actually equated to around £26,000 back in 1996, that we then invested in buy to let property, how has that portfolio grown and what would it be worth today? We've assumed that this initial £50,000 was invested into a limited company that was then used to purchase buy to lets. So you'd be paying corporation tax rather than income tax, amongst several other differences as well. And we've also assumed that every property is bought using a 25% deposit and a 75% mortgage, and that all profit made from your rental income after you've had your sort of mortgage costs, maintenance, and tax all deducted is then reinvested back into the company rather than being taken out to supplement an income. And that's quite an important assumption for this one. So every 5 years, we've checked in on the portfolio and we've revalued it. And what we've done is we've assumed that you can remortgage all of the properties within that portfolio back to a 75% loan to value. And you've extracted that income to reinvest into purchasing new properties. And this is ultimately how the portfolio grows over time. And without needing further investment from outside the company, you're just reinvesting money from your rental profits and capital growth. So, what did we find? Well, we found that if you invested your £50,000 in today's money back in 1996, the average portfolio in Great Britain would now be worth just over £4.1 million. And the chart on the right-hand side here shows you how this figure has varied depending on where you invested that money. So you should be able to see that investing in the Northeast actually reaped the biggest returns over that 25-year period. And London sits sort of somewhere in the middle there. On an annual basis, the average buy-to-let portfolio in Great Britain grew by around 30% each year through a combination of both that capital growth and rental profits too, which is quite staggering within itself. But I think it's important to remember that given the pace at which house prices actually rose, particularly in the sort of late 90s, early 2000s, capital growth has accounted for 65% of the increase in the portfolio value over that 25-year period. And the rest of it, so that extra 35%, has come from rental profits. Now, whilst we've assumed that all rental profits have been reinvested, typically many people actually grow a portfolio so they can sort of start withdrawing that income, particularly when they retire. And if you were to do that, the average portfolio that sort of began in 1996 would now be generating around £243,000 each year in rental income. So you can just see how that sort of growth has taken place. So that's a little bit of background. And with all of that in mind, I thought it might be useful to pick out some of the 3 key lessons that we think landlords can learn from this journey. Well, firstly, given the sort of bumpy ride that house prices and rents can go through, diversification is absolutely key. And as we've already seen, the amount of money that landlords have actually made from growing a buy-to-let portfolio has varied quite considerably across the country. And also, given the number of uncertainties facing the housing market in coming years, like Simon was talking about, investing in different regions is a really good way to spread your risk. But I think it also depends on what you want to gain from your investment. If you're planning on extracting regular rental income, then you're probably better off buying further north, where yields tend to be that little bit higher. But actually, if it's capital growth you're after, historically it's the south that's performed best. And as you can see from the chart here, 79% of landlords' portfolio growth between 1996 and 2021 came from capital growth if they were fully invested in London, versus just 39% in the northeast, where house prices have lagged behind, but yields have been higher and sort of made up for some of that gap. And I think it's also important to remember that you don't just have to diversify geographically, but you can also diversify your portfolio by buying a mix of urban and countryside properties and different property types too. Because since the pandemic, we've seen rents shoot up on larger sort of country homes, but pre-pandemic, it was city centre flats that were in highest demand. And it's also these areas and cities where yields are starting to pick up once again. Now, this second lesson sort of relates to the last point, actually, and it's all about how timing can make all the difference when investing in property. So it's really important to consider where we are on that property cycle. Now, an investor who timed the cycle perfectly over the last 25 years by always investing in the fastest growing region would see double the average return compared to someone who invested in the slowest areas. Now, this graph that you can see here solely tracks the average difference between what someone bought a property for and what they sold it for in 2021, and based on how many years ago they actually purchased that home. So what you can see is someone who bought 5 years ago would have seen stronger capital growth by investing in the north, whereas if they bought 10 years ago, they would be better off having bought in London, where prices actually recovered pretty quickly following the 2008 financial crash. But I think what's quite interesting is if you then look a little bit longer term, going back 20 years, you can see that while London house prices actually rose the most, that gap between the north and the south is a little bit smaller. So while longevity can be a bit of an equaliser, buying in a mix of geographies is also a good way to spread your risk too. And just finally, the third pointer really is about how using leverage, i.e., how using a mortgage, can help you supercharge your returns. And in my opinion, this is an absolute must for any investor. Throughout the analysis, we've assumed that a property within the portfolio never drops below that 75% loan to value mark, and any value over that's extracted and reinvested into new properties. And if you didn't build a portfolio through using debt, after 25 years, the average cash portfolio would actually only be worth around £272,000 compared to over 4 million for a landlord who used leveraged. And that's based on equity, so not just the total value of all the properties in your portfolio. And it's one of these sort of mathematical conundrums in a way, but in its sort of simplest terms, it basically means that a landlord who used leverage is then able to buy a £200,000 property with just £50,000 in cash. So if prices rise by 10%, mortgage investors actually see a return of 40% on their initial investment before any costs, because they've also gained value on that borrowed money, not just the cash part. Whereas cash investors would only get the 10% return on their 50K. So you can see quite big differences, really. And you can also see from this graph here, it also shows the impact of reinvesting rental profits rather than extracting them to supplement an income. And nationally, the average portfolio would be around 55% smaller after 25 years if rental income was withdrawn each month rather than reinvesting it. But a landlord's ability to do that does very much depend on their circumstances and whether buy-to-let is their sole income, perhaps like in retirement. But I think it does show that reinvesting rental profits is a really good way to scale a portfolio more quickly. And just finally, for me, I thought it might be useful to just end on a few forward-looking thoughts. And I guess, like the classic caveat on any investment product will tell you, I think past performance absolutely isn't necessarily a guide to future performance. And Simon made that fairly clear at the beginning of this as well. We've definitely seen considerable house price growth over the last 25 years, but the gap between house prices and people's incomes has grown substantially too. And this is the main reason why we don't think house prices and rents will rise quite as much as they have done in the past. And I think also, while we've just come out of a period of exceptional price and rental growth, like those nationwide figures show today, which is truly remarkable given the sort of economic backdrop and the uncertainty caused by the pandemic, we do think price growth will slow over the coming months and years, and it's more likely to rise in line with people's incomes. So probably around the 2 to 3% mark rather than the 10% we've seen over the last year or so. And on a regional basis, we've seen the gap between house prices in London and the rest of the country grow substantially over the last decade. But as we've also seen today, over the last 5 years, that gap started to close. And we think northern regions will continue to see the strongest house price growth, probably up until around 2024, when we think perhaps a new housing cycle might begin. And historically, a new housing cycle has also marked a period where London starts to outperform other regions again. But because this north-south divide gap sort of thing is unlikely to close as much as we've seen in the past, we still think there's going to be a little bit less divergence in house price growth between the regions in the future, and they're more likely to rise a little bit closer together rather than London completely pulling ahead like we've seen in the past. But that being said, and just to sort of finish and round off here, I think undoubtedly one of the biggest lessons I've learned is that it is unbelievably hard to predict the future. And I think the pandemic and the war in Ukraine are a reminder to all of us of that. The days of being able to sort of buy properties, see considerable house price growth and sell on within a year or so are almost long gone. And so I think it's really important that investors treat any portfolio as a long-term investment, just in order to protect yourself from any bumps along the way. And for me, one of the key things landlords need to be prepared to do it's one of the key things that landlords need to do in order to protect themselves for the future. Simon, I hope that's given everyone a bit of insight into what the findings of the report are. I'll hand back to you.
Aneisha. Some really interesting points there, plenty of food for thought. I know that I've got lots of questions. I hope you have. Some of you have already sent in some questions, so thank you for that. If you have further questions, which I'm sure you will as you listen to our panel discussion, it's the button in the top right-hand corner. So I'm going to bring everyone back in to remind you, we've got Catherine, we've got Ralph, we've got Aneisha. You're all on hand. You're all waiting for questions. Now, as you know, I live in London, so I'm interested in the London market, which I've seen at times has been crazy, absolutely crazy. So I had a feeling, and it may well be wrong, that London's not great for buy-to-lets. Catherine, you can probably answer this. Is London too risky for buy-to-lets, or will the yields get better? And what about supply? What's going to happen to that?
Okay, thanks, Simon. So there's a fairly short and sweet answer to that. No, London is not considered risky from a buy-to-let perspective. It's not within reach for everybody. So not all investors will aspire to own buy-to-let property in London, because obviously capital values tend to exceed those of the wider national picture quite significantly. However, it does hold a broad global appeal. London always has. Our belief is it always will. There's nothing on the horizon that looks set to really change that. So it is not considered risky because it is still a popular destination. Historically, it's delivered reliable capital growth in terms of property performance when people do invest there. It's really critical, though, that from a buy-to-let investment perspective, anyone considering investing in the London market does their homework and does it carefully. There are broad variances between how the different boroughs and the different zones perform from a buy-to-let perspective and from a capital growth perspective. So it's really important that you do your homework first. You also need to be really clear, if you're an investor entering London or increasing your portfolio in London, what your investment goals are. Most investors tend to look for one of three things, if not a balance of all three. That is capital growth, its yield, and its monthly return or annual return. So it really does depend on what you're looking to achieve. We've heard from Aneisha already that capital growth tends to be strongest in the south of England, and that is notably so across the London area. You asked me whether yields are going to get better. I suspect potentially, yes, they will. Central London at the moment, rents are growing at the fastest rate across the country presently, and capital values are not increasing in line with that. So for an investor who has got the means to invest in London, I think there are the potential to find some quite interesting opportunities in this market at the moment. So I would certainly be looking at London if you have a capital budget that would facilitate that. Rents are rising at record levels. So across the national picture, yes, I think yields are likely to start to increase as we continue to see pressures on affordability and a lack of supply, which leads me beautifully into your last question, what's happening to supply? So nationwide, year on year at the moment, we've seen a 40% decline in the supply of available rental property. We estimate that compared to 2017, when we saw a peak of private rented sector housing, there are now 350,000 fewer private rented homes across the UK. So supply has been falling now for some time. As I say, 40% down year on year. And that's driven largely by probably three things. Circumstantial investors, accidental landlords, as they're sometimes called, took advantage of a strong sales market last year to exit. So if they didn't have long-term investment goals around buy-to-let and portfolio ownership, a lot of them have sold and left the market. Secondly, investors paused because capital prices really did hit something of a peak last year. Investors weren't active at that point in the market. We are starting to see them come back now, and that's really interesting. So we're pleased about that. But investors weren't buying. And the third factor here is that we are seeing more and more landlords selling to each other. They're not bringing new stock into the market. They're taking one portfolio ownership and moving it simply to a different landlord's name and company structure. So it is not bringing enough new supply into the housing market, and that is a nationwide problem.
Okay, well, that's again more food for thought. There's a lot to think about. I want to go back to fundamentals now. Ralph, if you don't mind answering a question about if I want to be a landlord, what do I need to do to get a mortgage? I mean, what's a minimum deposit? It's not as simple as getting a normal mortgage, presumably.
It's not as simple, and I think you mentioned deposit, and deposit's obviously the big question. So typically you'll need a 25% deposit, and if you've got a 25% deposit, you'll be in a really good position. If you've got a 40% deposit, that's when you're accessing the best rates. So obviously the more that you put in, the better. We are seeing some 20 or 15% products in the market. The slight challenge I would suggest when you've got products like that is that to try and get the sort of deal to stack up in terms of rental yields. As many people know, obviously, buy-to-lets are calculated not necessarily on personal income, but certainly on the rental coverage. So that's more challenging to stack up. In terms of, I think you said ticking boxes, in terms of ticking boxes, I think there's some fundamentals that you need to understand from day one. Certainly, I would say tax advice is one. Are you going to put the property into a sort of personal name or a limited company? It's never too early to plug mortgage advice, but certainly you need some mortgage advice. I don't want to say it's a minefield out there, but there is a lot of choice. If you look at my business, for example, we used about 25 different buy-to-let lenders last year. There's certainly a lot more lenders than that. Not all of them are household names, and they've all got their quirks. So I'm not going to start sort of talking to you about criteria, but whether it be sort of age, whether you're a first-time landlord, etc. There is a lot of choice out there. So I think sort of certainly getting advice would sort of be some of the boxes that I would look to tick, Simon.
That is good advice. As much advice and information as you can get is really helpful. You must be really fully informed before you make any investment decision. And buying a property is a big process. As Aneisha mentioned earlier, it's long term as well. So you've got to think all these things about it. Aneisha, I want to come back to you. You mentioned in your chat about reinvesting rental profits. Which I hadn't really thought about this, but you've got this money. Do you really think that releasing that money that you got from one property to the next is the best way to grow a portfolio?
Yeah, I think it can really help, to be honest, Simon. Reinvesting or remortgaging any properties that you've already experienced some house price growth on just enables you to scale your portfolio much quicker. But of course, it is dependent on capital growth, and it is dependent on going through a period where house prices have risen. But by sort of leveraging as highly as you can gain from capital growth on borrowed money as well as your own, which is a big thing. I think the only thing to consider is if you're a first time landlord, I think sort of borrowing as much as you can is a very good option. But from a risk perspective, if you've already got a few properties and you're looking to kind of spread your risk a little bit more, it might be sensible to have a fewer loan to value buy-to-lets at different sort of levels. Because as Ralph was saying, generally, if you've got slightly more equity within those properties, you are able to access better interest rates. So just something to consider.
Okay. There's an awful lot of things to think about, when you're doing this. And I think once you get more than one property, you've got a portfolio. Now, does that change the game? Catherine, perhaps you can look at this. What decisions do landlords who have large portfolios take that are different to those who are just starting out? And presumably, has that changed over the last 10 years?
Yeah, thanks, Simon. It actually has. And those changes in thinking and planning and logic and structure between landlords just starting out and those who are more experienced and probably have larger portfolios, the change in logic there has largely been driven by changes to the tax structure and the tax regime. So what we'll tend to find is larger landlords there are probably three main differences. One is they will have a clear strategy, whereas somebody starting out isn't yet in that position. They don't need one, arguably, whereas a portfolio operator really does. They will have long-term goals in mind. They'll be clear on what their exit strategy probably is. Therefore, they will be shaping a portfolio around whether they are looking for income in retirement versus a capital lump sum at a certain point of exit later down the line. And they will be taking more commercial views around what to invest in, what to spend thereafter, how to refinance. They will not be so subjective or emotive about what they buy and where they buy it. This is a commercial investment decision. Secondly, their investment logic is slightly different to newer landlords. So new landlords tend to be driven by capital growth, whereas actually more established landlords often tend to look for the yield as a priority over that capital growth. And we've heard from Aneisha, it is important, and actually portfolios perform better where there is a diversification, a spread of risk across capital growth, monthly yield, monthly return and yield. The other thing is that new landlords will tend to play safe. So new landlords either are circumstantial to begin with or accidental, i.e. they move in with a partner, they emigrate, they inherit a property. There is a reason why they have become a landlord. Those types of landlords probably know the area where that property sits. It may be local to them. Whereas, again, professional investors will be looking at a far broader territory and geography. They will be researching local market rents. They'll be researching tenant demand. They will make decisions about investment areas that really don't have much consideration for proximity to where they live or where their existing portfolio operates. They're looking purely at a commercial opportunity. And lastly, professional landlords and portfolio operators probably structure themselves differently. They will be using special purchase vehicles because they are generally more tax efficient. Smaller landlords tend to start with property in their own name. And as I say, that's not something that we would tend to see larger portfolio landlords continuing to do for long. Larger landlords also tend to diversify in a more considered fashion. So that might mean holding residential property, but it may also mean starting to spread into commercial property. So there's some big differences really between those small, just starting out landlords and the larger portfolio operators. But essentially, one is generally circumstantial, situational, and it's taken at a much slower pace. When you're entering buy-to-let for the first time, you're cautious, quite rightly so. These are large sums being invested and you're leveraging significant amounts of debt. So that is the right approach. Whereas professional landlords who are perhaps a decade down the line are more familiar with the risks. They're more comfortable with the risks they are each prepared to take. So it does very quickly, that comfort will come. The right advice from letting agents, from accountants, from solicitors about how to structure special purchase vehicles, own property in company names, that builds confidence for portfolio owners quickly. So it's really just that age and stage difference between somebody just starting out compared to somebody who's been doing this for a lot longer.
Yeah, I think I would exercise caution actually wherever I was in the game. But that's all good advice. Ralph, I wanted to come back to you because I noticed recently that energy performance certificates (EPCs) have come into the frame of properties, and some lenders offering higher loan to value deals on higher rated EPC homes, while others offering lower rates. Now, is this just a gimmick? Is this a short term thing, or do you think the EPC ratings will eventually come to define the mortgage market?
Okay, so we're talking about, well, there's been a lot of press around green mortgages, and I really don't want to be quoted, and lenders wouldn't be happy if I use the word gimmick, rather than, I think you did say gimmick, I think, Simon. I would say they're more probably at a development stage. If you look at if you look at the mortgage market, particularly obviously the buy-to-let market, we're seeing a lot more products come to the market with green credentials. Let's be clear, they're not green mortgages. And what I mean by that is there's nothing green about the mortgage process itself. It's just that these products may offer a customer cashback or a slightly cheaper rate. But I would say if you sort of look at the advice market for sort of mortgages at the moment, fundamentally all brokers are sourcing on what is best for the customer in terms of cost of that mortgage over over the product term, as opposed to the green credentials. But I think there is a game changer on the horizon, and the government certainly see mortgage lenders playing their part in terms of the UK trying to get to the net emissions by 2050, I think it is. And there is talk that lenders could have to balance their portfolios. So they might say that mortgage lenders must have 15% of their properties, or will be higher than that, a proportion of their properties in let's A bands, B bands, C bands. And when we get to that stage, I think that's when it does become an absolute game changer, because lenders will start basing lending decisions on the EPC rating of a property. It could have impacts on how much customers can borrow, because they will be measured on it. But we are some time off that at this moment. The government is certainly in consultation and making noises as that's the approach that they will go. So at this moment in time, it's not a big thing. It's a small part of the market, but it will certainly change over time.
Yes, that's interesting. I mean, it's something to bear in mind, isn't it? But it's not going to impact immediately. I like looking forward to the future because, well, there's a little bit of guesswork, but it's important to be aware of what might happen when you're making decisions today. One thing is, I know some of my friends who've gone to buy-to-let has they set up a company to run it. Now, is it worth doing this? Probably, Aneisha, you could probably answer this. So, simple question: is it worth putting a buy-to-let property in a company? What are the advantages, and of course, what are the disadvantages?
Yeah, it's probably one of our most asked questions, actually. I think there have been huge numbers of buy-to-let companies set up over the last couple of years, and it's really a trend that's catching on. But it all comes down to individual circumstances. So my first point is make sure you speak to your accountant or tax advisor on this one, because it really does vary. As a general rule of thumb, I would say it's normally worth putting buy-to-let properties in a company if you're a higher rate taxpayer, but it can work out more expensive if you're a lower rate taxpayer. The only caveat to that is if you are a lower rate taxpayer at the moment, but you're thinking of growing a portfolio, then it's probably worth setting up a buy-to-let limited company now at the beginning of your journey. But there are lots of advantages and disadvantages, and I'll just run through some of the main ones, I guess. One of the biggest advantages of putting your buy-to-lets or running your buy-to-lets through a limited company is that all expenses are tax deductible, and that includes your mortgage interest, where there are limitations in what you can deduct when you now own a buy-to-let in your personal name. In a limited company, you also pay corporation tax, which is around 19% at the moment. And that's a little bit lower than income tax, particularly if you're a higher rate taxpayer. And you also pay the same stamp duty when you're buying a buy-to-let property as you would if you were an individual, which I think is worth bearing in mind. One of the biggest benefits, which often comes slightly further down the line, is that you wouldn't actually pay any capital gains tax if you sold your portfolio to another company, which, when capital gains tax is 28% for a lot of taxpayers, it's a huge saving to be had. But there are quite a few disadvantages as well, and particularly running a company and setting up a company has its own costs associated with that, its accountancy costs and things like that. So it's worth doing your homework on that one. And you're also slightly limited on how you can then extract money out of the company. So if you wanted to use it as an income, I think the annual dividend allowance for each director is around £2,000 a year at the moment. But then you would be taxed if you took anything above that out, probably around, I think it's 7.5% for a lower rate taxpayer and just under 33% for a higher rate taxpayer. Just to finish on two other big disadvantages, one of the big ones, which Ralph actually touched on, is that mortgage interest rates, if you own a buy-to-let property in a company, tend to be charged a premium. So generally, mortgage rates are around 3.5%, whereas if you own a buy-to-let in your own name, you'd only be paying 1.7%. So it can make a big difference on your monthly mortgage costs. And if you already own a buy-to-let in your personal name, it's also just worth remembering that if you wanted to transfer it into a company, you have to pay stamp duty, which again might just sort of kind of put you on the edge of doing something.
Okay. There's again a lot to think about with that. Here's a quick question for you, Catherine, on the same subject. Does putting the buy-to-let into a company name vary depend on whether you have a short-term furnished let or a long-term unfurnished let?
So there are likely to be tax benefits to both profiles of landlord in those two scenarios. So it is worth further exploration. As Aneisha said, it's a conversation definitely for an accountant. The treatment of long-term lets versus short-term holiday lets, furnished holiday lets in particular, can differ. For example, the assets and the losses of a furnished holiday let can qualify as exactly that, trading assets and trading losses. So that can be advantageous in the furnished holiday let world or in the short-term rental world. It's not quite as black and white as that. There are obviously some loopholes and some caveats around what you can and can't do with those opportunities. So it's certainly a conversation for an accountant. But yes, it's likely to benefit landlords in both long-term lets and short-term lets to look at a company structure.
Yeah. So, Ralph, over to you on the rates. And Aneisha mentioned that you pay almost twice as much getting a mortgage in a company name, 3.5%. You mentioned, as opposed to roughly 1.7%. Is there? Do you think there'll ever be a time when limited company buy-to-let mortgage rates ever reach parity with those offered in personal names? And if so, when is that going to happen?
Okay, so yeah, Anisha's right. If you look at lenders that offer, let's say, both sort of personal buy-to-lets, limited company buy-to-lets, the differential can be between 1 to 1.5%. So it is significant because I think if you've got sort of, let's say, a 300,000 mortgage, every percent is another £3,000 a year that you're paying, or 250 a month. I think in terms of parity, and if I was to put my mortgage lender hat on here, I don't think we'll see parity for some time, or we may not see it at all. And there's a couple of reasons for that. One is about choice. If you look at limited company buy-to-lets, I should say there is a lot of choice, but there is less choice. So, for example, you've got a lot of high street players who don't operate in the limited company buy-to-let market, Santander, HSBC, two of sort of several that I could have mentioned. So you've got less choice, and I guess in a lot of areas where you've got less choice, you probably get less competitive pricing. The second factor, which is why I don't think you'll necessarily see parity, and I guess it depends whether you're a consumer or lender and what view you take on this one, but a mortgage lender would say that a limited company buy-to-let is more complex for them to underwrite and more costly. And there is some truth in that, because the simpler the mortgage, the more automated it becomes. So we see examples in the residential mortgage market where you get a vanilla sort of first-time buyer or a remortgage that will go straight through, it'll go automated underwriting, and you can get a mortgage offer within 24 hours. When you go into sort of limited company buy-to-let, certainly you've got more experienced specialist underwriters looking at it. So there is less automation at the lender's end. And my experience, sort of having worked at a lender, is where you've got less automation, it becomes higher cost. So I guess the simple answer to your question is, I'm not going to say there's never going to be parity, but I certainly don't see it for some time due to choice and obviously what I've just talked about. So apologies, I'm just about to cough. Thank you.
So that all makes sense to me. Listen, we're getting loads of questions in from people watching it today. I'd like to get to those as soon as we can, but before we do, just I'll sort of round up looking to the future, because we all want to know what's going to happen in the future. So let's turn to you, Aneisha, first. We've seen fantastic levels of house price growth, which has really helped buy-to-let returns. You mentioned that the 14% that we've just said today, there's a low growth forecast. I think you mentioned between 2 to 3%. So do you think that's going to put people off from buy-to-let?
Possibly. I think it's definitely a risk, purely because house price growth has made up such a high proportion of investor returns in the past. And I think one of the numbers that we put in the report that might be sort of a useful context is that actually, if that portfolio over that 25 years had seen no price growth whatsoever, it would only be worth £250,000 instead of over 4 million. So you can see the role that house price growth has played. But I mean, that's not to say that we're forecasting zero price growth. We still think prices will rise, but probably, like you said, Simon, around the 2 to 3% mark. And I think also we have to sort of take a bit of a step back and look at the bigger picture. We're living in a high inflationary world where interest rates are starting to creep up, and many people are turning to buy to let as a hedge against this. And I think one of the benefits of buy to let is that it enables you to draw an income from charging rent too. And for many investors, this is actually their main priority. Capital growth is just a bonus. And that's sort of the way that I think of buy to let. If you focus on yield, anything you earn capital growth wise is just a bonus. But again, sort of having a mix of geographies should help balance the trade-off between yield and capital growth expectations in the future too.
I mean, I think you called it a bonus. It's been a tremendous bonus, the increase in the assets over the past few years. But you're right to be cautious. That isn't likely to continue. Catherine, stock levels are record lows, rents are record highs. Is there going to be something that's going to change that around and maybe put a downward pressure on rents, do you think?
Nothing I can see in the short term. No, I think unless we start to see a rebalancing of the imbalance currently between supply and demand, I don't see anything significant on the horizon that will change. As you say, we've got tenant demand at record highs. We've got the supply of stock and property and available units to let at record lows. I think that supply shortage, we've heard a little bit in the sort of wider market about build to rent and how much of a pressure that will lift and ease on the lack of supply. There are more and more units. It is a growing sector. There are more and more build to rent units now, either in planning, under construction, or starting to lease up, but it only accounts for between 1% and 2% nationally of the total supply of rental stock at present. So in itself, it's not enough to alleviate this pressure and this problem. We may start to see, there is talk about easing the stress testing on lending for mortgages. And if we start to see that and home ownership becomes easier, that may take some of the tenant demand out of the market. That may help. But at the moment, I'm afraid I don't see significant change likely. I think at the moment, the cost of living is outpacing wage rises. So affordability is likely to continue to be the main pressure on rental rises, which is why our forward forecasts are reasonably conservative. Affordability is a legitimate consideration both for tenants but also for landlords, because what you don't want are tenants overcommitting to something that they then can't service and sustain for the term of the tenancy. So no, I don't see anything in the short term that will start to put that downward pressure on rents. In the medium to long term, potentially.
I mean, you mentioned affordability. That is crucial, isn't it? You know, anyone who's thinking about investing to buy to let needs to be thinking about affordability. Now, one key aspect to that, apart from the cost of living crisis, is the interest rates. You know, and they started rising. And the Bank of England's predicted inflation could hit as much as 10% this year. Now, that's going to presumably keep the pressure on them to increase interest rates. Ralph, what do you think is going to happen to rates over the next year or so?
I don't know if I want to answer a question about base rates. I'm not sure my economics A-level many years ago is going to help me on this one, but it's a difficult one. So if you look at what we've had 3 rate rises in the last 4 months, and they're definitely going up. There's no doubt about it. Interest rates, a base rate will go up again this year. And if you look at the last Bank of England meeting, I think they voted 8-1 in favour of the change and absolutely signposted that they will increase. The expectation in the market is that they could touch 1.5% base rates towards the end of this year, rising to maybe 2% in 2023. So that's the market consensus. And I'll talk a little bit more in a bit about the impact of that on mortgage pricing. What I would qualify it with saying is there is an alternative view, and I've got a lot of sympathy for the Bank of England in terms of setting base rates at this moment in time, because the challenge that they have, and I don't want to use the word stagflation, but we're getting to a situation where inflation is increasing significantly and economic growth is extremely slow. And then interest rates becomes quite a blunt instrument to try and solve that problem. So while the market expects, as I say, 1.5% probably by the end of this year and maybe 2% next, there is a school of thought that that actually might not happen for the above reason. In terms of mortgage rates, I think over the last year we've seen them go up. If you look at sort of a 5-year fixed rate, 12 months ago you could get something at 1%. You're now nearer 2%. I should add that that's still historically cheap. And if you look at the graphs, that sort of cheap's probably not the word I want to use, but if I look at the graphs that Aneisha showed earlier, there were a lot higher mortgage rates in the past, as we all know. So to some extent, some of the base rate rises have been priced in already, probably perhaps the next one, but certainly I think we should expect mortgage rates to increase over the next 12 months as base rate increases.
Okay, that's food for thought. Listen, we've got so many questions coming in. I'm going to start taking those questions and put them to you. Answer as best as you can. Once we've rattled through those, and we've run out of time, so we do need to rattle through them, get your answers as quick and concise as you can. And then to round up today, I'm going to ask you to round up with tips. So we'll come to that in a while. First the questions, and there are some fascinating ones. The first one's for Aneisha. This person says, do you forecast that the government will bring in further what they call anti-landlord measures in the future? So do you think there'll be more anti-landlord measures to come?
I think it's definitely a risk. We've already seen some quite harsh taxation changes for landlords be introduced sort of from the 2016 mark. And Sadiq Khan in London is calling for rental caps and things like that. But I have to say, sort of while everyone sort of gets really, really scared about rental caps and possibly at the moment it's a little bit different because we're seeing rents rise quite considerably on an annual basis in London because they are recovering. But generally, with sitting tenants in particular, landlords, it's quite hard for landlords to put up the rent. So we don't sort of, it wouldn't be the end of the world for the rental market in London by any means. So I think any new landlords and investors have to be aware of the fact that we might see the stamp duty surcharge increase by an extra % or so, for example, on second homes in the future. I think they've done what they need to do about landlords being able to deduct tax relief, but there are certainly things that could be implemented in the future, yes.
Thank you for that. Next question's for Catherine, and I hope it's from someone who hasn't been stung in the past, but they ask, how can you make sure that letting agents are credible?
Okay, meet with them, look for accreditation. So ALA is still the most widely recognised accreditation body. There are increasing quantities and qualities actually of regulation around letting agents, the letting sector. It is really important that you do understand that your agent is complying with everything that's required of them. So things like client money protection, having that in place around protecting tenant deposits, being members of a scheme that also protects tenants' deposits, making sure that they are following the Tenant Fee Act, not charging when they shouldn't be, really advising and operating in line with, all of the current regulation and legislation, but also are able to advise you about what is ahead. So Aneisha's just mentioned the possibility of rent controls across London. The Renters Reform Bill, which is sort of slowly passing its way through process at the moment, could have some quite big changes on the horizon. So it's really important that you're working with experts who understand the sector that we're operating in, and no matter what the law requires of us, they are operating above and beyond that in terms of their understanding and their competence and their ability to advise and guide a landlord about what steps to take.
Yeah. One question that's come in is about age. Now, I would assume that the age of someone investing in buy-to-let is irrelevant, but someone's pointed out there are a lot of lenders have maximum age barriers when you get to 65 and older. So it's a question for Ralph. How would you advise older people looking to buy-to-let? And because banks are disinclined when you get older to lend. Is there a way through this?
There is, and I think this is where we're quite fortunate in the buy-to-let market that there is a lot of choice with lenders. So if you look at some of the mainstream lenders, typically they might say that the maximum age application is 70 to 75, or they'll take the term to 75 years old. But you have specialist lenders who will take a term to 85 years old. Even outside of that, we've done stuff on sort of on a lifetime basis. So I don't think age is necessarily a barrier in buy-to-let, but there is a lot of choice amongst lenders. So speak to a mortgage broker or speak to someone who can give you that advice, because they will help you navigate it, because there is choice. But I do agree that if you just look at some of the high street lenders, it would probably suggest that there are barriers. But certainly when you dig a bit deeper, they're not there necessarily.
Okay. Aneisha's question for you, something you said in your when you were talking earlier, you mentioned leverage. Now that looked very attractive. Increased returns by leverage. This person says, do you mind elaborating on leverage?
Oh gosh, I think we've talked about leverage an awful lot today, haven't we? He might need to ask me a specific question on email for this one, but I think leverage is all about using a mortgage. So the example that I talked about earlier was, if you have £50,000 worth of savings, if you were to buy a property with cash, you're probably only able to use £50,000. Whereas if you're able to use a mortgage and get a 75% loan to value mortgage, which is generally the maximum most lenders will happily lend on, as sort of Ralph was saying, you're then able to buy a £200,000 mortgage, which means that you can gain from any house price growth and rental income on £200,000 rather than £50,000. But if I haven't quite answered that question properly, then feel free to follow up on that one.
That's really helpful. Next question. We are rattling through them now, I'm glad to say, because there's quite a lot to come. And I'm conscious we're running out of time as well. This next one's for Catherine. Someone says, is buy-to-let suitable for investors with more than £20,000 capital, especially in the London market? Where should I go for more information about where to invest and about my investment?
So just to be clear, is that someone who has a capital pot of £20,000 and is looking to enter the buy-to-let?
Yes.
Yeah. So I think it's probably unlikely that you would be able to enter the London market. It's unlikely that you would certainly be anywhere. If you can, you would be unlikely to achieve that 75% loan to value that we've talked about being optimal today. So I would probably suggest that investor starts to look beyond the M25. Again, advice is important. So if you'd like to email me following today, I'll very happily have a look at your individual situation and put you in touch with some experts at our end who can help to point you in the right direction.
That's really helpful. I mean, and do get in touch. I'll give you an email address at the end of this, where you should send the questions, and you'll get swift and informed answers. The next question is for Ralph. This person says, I'm looking at a limited company buy-to-let mortgage, but personally I'm looking to move. So this is quite excitable. If he or she gets a buy-to-let mortgage, will that affect their personal mortgage offers? Will it make it harder to find a deal for their own mortgage?
The short answer is no. So the majority of mortgage lenders, let's say you're sort of applying for your residential mortgage, providing that the buy-to-let mortgage pays for itself, and by paying for itself, I mean that you sort of the rental income is covering the mortgage payment. The majority of lenders will remove that as a credit commitment as such, so it won't impact your residential purchase. So it's not impossible to impact the residential purchase, but it would be highly unlikely. So we are doing residential mortgages for a lot of buy-to-let landlords, and the portfolio is not necessarily having an impact. It can actually have even a positive on the residential mortgage, because some lenders will allow us to use the profit from buy-to-lets as additional income. So there are some cases where you can actually, being a buy-to-let landlord will help you, because you can borrow more.
Okay. Here's a direct question, which I think is for Aneisha. What areas return the highest yields? I think if you can name the actual property someone should invest in, that'd be really helpful.
That would be handy, wouldn't it? Although I think I might be snapping it up myself. So generally, on a regional basis, it's the northeast that always commands the highest gross yields. But you have to be a little bit careful, because gross yields do mask the fact that there can be quite substantial costs, particularly on flats and things like that. But zooming in a little bit more, not quite to property level, I'm afraid, Simon, but it's always places like Hartlepool, County Durham that tend to come top of that list. And they happen to be some of the cheapest areas in the country. So if you do have a fairly smaller pot of money that you're looking to kind of make use of in buy to let, then they are definitely worth having a bit of a look. But always get to know that local market and talk to the experts.
Yeah, good advice. Good advice. It's a shame that you couldn't give us the insights that we really wanted, but that's an impossibility. A quick question for Catherine here. Can you share your thoughts on the performance of buy to holiday let, I should say, buy to holiday let compared to just regular buy to long term let? What pros and cons?
Pros are, generally speaking, higher returns. So when a short-term investment, a holiday let or a short-term, a short-let property is let, it achieves a premium. That could be anything between 30 to 70% of the long-term rental value, depending on time of year and location of the property. So that's generally the biggest pull. The downside is the period of void. So generally speaking, with holiday lets in particular, and often short lets, the amount of time over a 52-week year that the property is sitting unoccupied is higher than it obviously would be on a 12-month tenancy where you would have no void in theory. An interesting mix, therefore, is to have a look at the holiday let market alongside the short-term rental market and perhaps combine those two. But again, if somebody would like specific advice, we have a strong short lets department here at Hamptons, and obviously we deal in long-term tenancies as well. So I'm very happy to receive an email from someone who would like particular advice.
When we're thinking about holiday buy-to-lets, I presume you have to be as diligent and do your research as properly as normal ones. I make sure that you're going to be able to get tenants. So it's no good, I don't know, having a holiday in Cornwall and then think, wow, this is great, I'll buy a property. You need to do your research properly. Is that right?
Yeah, absolutely. And it comes back again to talking to the experts. There are lots of boutique specialist holiday rental companies operating in all of the most popular territories. It's well worth a conversation with them. Holiday lets is different to short lets. Again, we specialise in short lets as well as long lets, so I will happily give specific advice if somebody would like to get in touch with me. But if they have a particular location in mind, it's really important just to have a look and see what else is there. What are you competing with? What is a typical occupancy rate for a holiday let on an annualised basis, so that you understand how much that property is then likely to be occupied.
I mean, I always think it's about putting the personal into it. Just because you love a particular place, does that mean lots of other people? And you've got to be thinking widely, haven't you? Ralph, a quick question for you on mortgage rates. They're rising now. So does that mean lenders are adapting their stress testing?
Yes, there's a consultation. So certainly lenders will stress above the pay rate that you pay, typically around 3% or 2 to 3% over the sort of standard variable. So yes, it will have an impact, perhaps, but we're only talking around base rates rising, what did I say, by sort of about 1.5% by the end of the year. So I think there'll be a small impact, but I don't think we'll see any dramatic impacts on affordability with raising interest rates around stress tests, Simon. If that makes sense, because I sort of muddled my words at the end, but I think it came out correctly.
Yeah. It came out perfectly. I understood what you said. I hope everyone else did. All right. So finally, I want to get your tips. But all three of you, starting with Aneisha, then Catherine and Ralph, to give us 2 tips. The top tip you'd give to someone new, someone buying their first buy-to-let, and then your tip for someone who's thinking of adding to their portfolio. Just one tip, one bit of advice that they can take away. Aneisha first.
So my biggest top tip for new investors is do your research and don't overpay for a property. One of the biggest mistakes that landlords who earn the lowest yields make is overpaying for a property. And actually it's the price you pay rather than the rent you achieve that generally makes the biggest difference to yield. So get to know your area really, really well before you start offering. And I think my tip for existing investors who perhaps have a little bit of a portfolio and are planning on adding to that, I think we've talked about it a lot today, is diversification. It really is the best way to safeguard your investment for the future.
Yeah, good advice. Catherine?
I would echo both of those things completely. The only advice really for any first-time investor is take advice, talk to an accountant, talk to a letting agent before you talk to the estate agent, because Anisha's just said it's all around paying the right price. So understand likely levels of local rental, tenant demand, make sure you're appealing to the right audience. for an established investor looking to add to his portfolio, in addition to what Aneisha has just said about diversification and balancing that risk, I would say know what your exit strategy is. That should be driving your investment logic.
Yeah, that's something that people don't always think through. There has to be a long-term plan. Are you going to sell this to fund a yacht, or is there someone with is money for your family, whatever it is? So you need to think about that right up front. Ralph, your two tips for the new investor, for someone adding to their portfolio.
I'll give the same tip for both, and I would say be very mindful of the EPC rating of the property, because it will have a big impact in a few years. So buy-to-lets need to get themselves A, C. So if you're buying a D property or an E property, you may have a hefty bill to pay. I read something that's saying it's going to cost between £7,000 and £15,000 for landlords to get their properties up to A to C rating. So be mindful of the EPC rating, would be my piece of advice to both.
Great. Well, that's brilliant. Thank you all for those insights. There really is a lot of things to think about. I know the thing I'm taking away is let's build up, let's grow. Of course, you can't run until you can walk. So those tips about researching is essential, and you should know it's essential to any investment you make. With a property, it's not just about looking at the local marketplace. It's looking at finding the right tenants. It's looking at the future mortgage costs. It's looking at potential government risks. Will there be more red tape? Will there be more tax? And that final thing about an exit strategy is really quite crucial. You need to be having a plan for this. You're not just getting into this for a bit of fun. There's a reason why you're investing, so be thinking about that as well is important. Now, the two things I'm going to say to you: there's a full copy of the report that we've been discussing today, and it's on the research section of the Hamptons website. I would recommend downloading it and have a look, because it is interesting and entertaining, and it is full of insight. If you're new to the market, or if you're thinking about adding to your portfolio, there are some really crucial things that you should get on top in that. If you've got any questions, which I'm sure you have, I know I've got tons. The best thing to do is to email Catherine. I'll give you her email address. I'll repeat it twice so you get a chance to write it down. It's westerlingc@hamptons.co.uk. So that's westerlingc, one word, @hamptons.co.uk. Now, Catherine has promised me she will respond to everyone's questions, so don't hold back. Just send her whatever questions you have, and hope it's the start of a beautiful relationship. And I'd like to thank you all for attending today, and I'd like to thank those on the panel for some great insights. It's been fascinating for me. I hope it's been fascinating for you. So a goodbye for now.